So consider a firm that is planning on declaring $20 in dividends. The tax rates for a marginal investor are TCG is 25%. The tax on dividends is 35%. Compute the expected drop in share price when the stock goes ex-dividend. $20 in dividends essentially means 20 into 1 minus 0.35 coming to the shareholder. If CG was the capital gains, then I would have received CG into 1 minus 0.25, or the equivalent capital gains or the capital drop that would have been there from a $20 dividend would have been equal to 20 into 1 minus 0.35 upon 1 minus 0.25. That is $17.33. Suppose tax rate on capital gains is 30%. If the stock price of a company falls by 75% of the dividend amount on average when the stock goes ex-dividend, what is the tax rate on dividend for a marginal investor in that stock? So now we have to calculate the other way around, that if a D amount of dividend is paid, the stock price corrects by 0.75 into D. So D amount of dividends means D into 1 minus TD coming into the shareholders' pockets, and 0.75 D of capital gains means 0.75 D into 1 minus TCG or 1 minus 0.3 coming into the pockets. These are equal, as it is said that after a D payment the stock falls by 0.75 into D. No, it falls, no? D dividend, it falls by this much. How can a positive number be equal to a negative number? Positive will be equal to a positive number. So when a D dividend is paid, the equivalent capital gains is 0.75 of the dividend amount. Hence, can we compute TD? It is the only variable. D will get cancelled. So 1 minus TD is equal to 0.75 into 0.7, or TD would be equal to 1 minus 0.75 into 0.7, that is 47.5%. In other words, the tax rate on dividend must be 47.5%. That is, instead of, that is 0.75 units of capital gains would have given us the same wealth as $1 of dividend, because dividends are being taxed so heavily. So the clientele effect first says that whether you would prefer to give dividend or capital appreciation depends on the tax rates. Whichever has lower will be preferred. Following data is available for ABC Incorporated, a US company for 2013. Annual earnings are $1. Corporate tax rate is 30%. Dividend payout ratio is 100% of the earnings. Calculate the effective tax rate on $1 of corporate earnings paid out as dividends, assuming 18% tax rate on dividend income. So let's assume the $1 is profit before tax. Hence, the $1 that was paid out as dividend, hence the $1 that is earned as profit before tax will result in 1 into 1 minus 0.3 or $0.7 as profit after tax. From that, assuming this entire $0.7 is paid out as dividends, then the shareholder effectively gets 0.7 into 1 minus 0.18 because there is a dividend tax. That is 0.7 into 0.82. That is 57 point. That is 0.574. So $1 of corporate earnings before tax becomes 0.574 by the time it reaches the shareholder. So what is the effective tax rate? Let's say it is T. So 1 minus T would be equal to 0.574, or 1 minus T would be 0.574, or the tax rate would be 1 minus 0.574, that is equal to 42.6%. $1 of earnings gets reduced by 42.6% because of the various taxes by the time it reaches the shareholder. So effectively income is being taxed at 42.6%. We could have also calculated it by the formula that was presented earlier. That is, we first pay the corporate tax rate, that is 0.3. Then on the remaining earnings, this will be the PAT, we pay an additional 18% as dividend tax, giving us a total tax of 42.6%. You can calculate it either way, it will give you the same answer. So $1,000 would have effectively become $574, or a tax of 42.6%. So a US corporate's annual pre-tax earnings are $1,000. The corporate tax on retained earnings is 30%, and the tax rate that applies to earnings paid out as dividends is 18%. Assuming that the company pays out 60% of its earnings as dividends, and the individual tax rate that applies to dividends is 25%, calculate the effective tax rate on $1 of corporate earnings paid out as dividend. So calculation will be similar, only that the corporate tax rate applicable on this $1 will not be 30%, it will be 18%. So there is still double taxation happening, but at a lower rate. So you can solve it in the same manner as earlier. $600 is being paid out as dividends. So 600 is paid out as dividends. First it will be taxed at the corporate level. That rate is lower since it's been paid out as dividends. So it will be taxed at 18%. Just to clarify, this is profit before tax of 600. Total 1000 was the profit. 600 is what is paid out as dividends, and 400 was what is paid out or what is retained with the company. On this there would be a 30% tax levied. On the 600 there would be first an 18% tax levied, making this 600 into 1 minus 0.18. On this earnings that is paid out as dividends, then another 25% has been levied at as dividend tax. So the 492 further becomes 490 into 1 minus 0.25, that is $369. So effectively $600 has become $369 by the time it has reached the shareholder, giving us an effective tax rate of 38.5%. We could have again calculated it in the other method, that is, there was a tax rate of 18% levied first. Whatever was left after this tax rate was again taxed at 25%, will give us the same answer of 38.5%. So the earnings that are paid out as dividends are taxed at a different rate at the corporate level, so as to give some reprieve from double taxation. There is still double taxation happening, but at a lower rate. Philip and Morris both own 200 shares of stock in a US company that makes $5 per share in net income. The corporation pays out all of its income as dividends. Philip is in the 25% individual tax bracket, while Morris is in the 35% individual tax bracket. The tax rate applicable to the corporation is 30%. Calculate the effective tax rate on the dividend for each shareholder. So since it's an imputation tax system, the dividend tax rate will simply be the same as the shareholder's marginal tax rate. So in the case of Philip, he will get a refund of 5% such that his rate effectively is 25%. In the case of Morris, he will have to pay additional 5% to the government such that his effective rate comes out to be 35%. Let's do an example and understand better. In 2013, Dodge Incorporated had earnings of $10 per share and paid dividends of $2 per share. For 2014, the company expects to earn $15 per share with 50% target payout ratio and plans to bring its dividend up to the target payout ratio over a 4-year period. Calculate the expected dividend for the current year. So up till now the company has been paying something like $10 per year. So up till now the company has been paying something like $2 per year, and they want to eventually move their policy to a target payout ratio approach or a constant payout ratio approach. So the ratio that they are targeting is 50% of the earnings, and they want to reach this over a 4-year period. So the dividend in the next year would be given as the previous dividend, that is $2, plus the expected increase in EPS, that is an absolute number of $5. $10 is expected to go to $15. So $5 is the expected increase in EPS. The payout ratio targeted is 50% of the earnings, and this adjustment is expected to happen over a 4-year period. So this is the dividend that will be paid next year. So for the next 4 years, the dividends will be calculated by this formula. The year after that, this will become 1 by 3, assuming again a $5 increase happens. Then it will become 1 by 2. Then it will become 1. And finally, the company will just calculate 50% of the earnings and pay that amount out as dividend. So in this case, it comes out to be $2.625. That is the next year's dividend. ABC company has $5,000 earnings for a year. It has a target debt to equity ratio of 0.5. It's not debt to assets, or it's not leverage ratio. It's debt to equity of 1:2. ABC has a capital expenditure requirement of $3,000. Calculate the residual dividend. If $3,000 is the capex requirement, then how much of this would be funded by equity and how much would be by debt? So since the debt equity is 1:2, we can see that 1,000 would need to be funded by debt and 2,000 would need to be funded by equity. Hence, 2,000 of this 5,000 earnings would go away in equity funding for the project. So what is the residual earnings? It would be 5,000 minus 2,000, that is equal to $3,000. So this company, if it follows the residual dividend model, will pay $3,000 as dividends. Now we studied this at level 1 as well, that is the impact of a share repurchase vis-a-vis a dividends. We'll look at it one more time. Best Incorporated has 1,000 shares outstanding having a current market value of $80 per share. Best earned $50,000 in profits for the previous year. The management decided that only 80% of these profits will be reinvested back into the company and is considering the following two options for distributing the remaining 20% to shareholders. First is pay a cash dividend of $10 per share or repurchase $10,000 worth of common stock. How would the wealth of a best incorporated shareholder be affected by the management's decision on the method of distribution, assuming no tax differences? So in step 1, please tell me, if the company does nothing, no dividend or no share repurchase, then what is the value of one share? The market value of the company is given as $80 per share. So if the company does nothing, the market value is given to be $80 per share. That is, the cash is in the company, there is no dividend that has been paid, there is no repurchase that has been done. If the company pays 20% of its earnings as dividends, then 20% of 50,000 profits is $10,000. So $10,000 has been paid out as dividends. Now if the company gives $10,000 as dividends, then every shareholder would receive $10 additional since it has 1,000 shares outstanding. So 10,000 divided by 1,000 or $10 would be in the hands of each shareholder. However, in the market value of the company, which was earlier equal to $80 into 1,000, that is $80,000, there would be a reduction of $10,000 since this $10,000 of cash is no longer with the company. So anybody who's looking at this company now would not value this $10,000 of cash. So earlier there was an $80,000 total market value of the company, which would now get reduced to the extent of $10,000 because of the dividend that we have paid. Split this amongst the shareholders, that is 1,000 shares. The value of the stock would now drop down to $70, or this is what would happen when the stock goes ex dividend. That is, the value would correct to the extent of the dividends paid. So in the second case, the total wealth of the shareholder would still be $80. It would be 10 in his hand, that is cash, and 70 in the value of the firm or the value of the stock that he is holding. So just a dividend payment doesn't increase or decrease shareholder wealth, which is logical also, because if it could, companies would stop doing business and only do dividend payouts or not doing dividend payouts. To increase value in a company, you need to have better customers, you need to have better business, more margins, etc. The third option is do a share repurchase to the tune of $10,000. If the company repurchases $10,000 worth of shares, then at a price of $80 per share, how many shares will the company be able to extinguish? $80 for one share. So for $10,000, you would be able to repurchase 10,000 upon 80. That is 125 shares. So the number of shares outstanding now will be lower to the extent of 125. So it will be 1000 minus 125, that is 875 shares. However, like before, $10,000 have gone out of the company. So the earlier market value was 80 into $1,000. The new market value would have been reduced to the extent of $10,000. So the new value of the company would be $70,000, which is split amongst a lower number of shares. That is only 875 shares, giving us again a stock price of $80 per share. So remember, doing a share repurchase or doing a dividend may have a signaling effect, but theoretically it cannot create or destroy value. If it could, there would be an arbitrage opportunity. Companies would not do business. They would do repurchases and dividends. We also studied that if company tries to borrow funds from outside to repurchase its own shares, that is doing a repurchase by borrowing funds, then what would happen to the earnings per share? So Best Incorporated plans to borrow $10,000 to repurchase shares. Best's finance director has compiled the following information. The share price at the time of buyback is $80. The shares outstanding before a buyback is 1,000. EPS is $50. The earnings yield is defined as the EPS upon the stock price, which is 50 upon 80, that is 63%. So it's a very high earnings yield. After tax cost of borrowing is 12%, and with $10,000 and $80 stock price, he can buy back 125 shares. Calculate the earnings per share after the buyback. So please understand, earnings per share is defined as the net income upon the number of shares. What a buyback would do is that it would reduce the number of shares. However, to the extent that you have used borrowing to achieve this buyback, the net income would also reduce because of the additional cost of debt or interest cost that will come in. So the earnings earlier were $50 into 1,000, that is $50,000. 50 was the EPS for 1,000 shares. So 50,000 was the earnings earlier, and 1,000 was the number of shares outstanding. The number of shares outstanding now would be 1,000 minus 125, that is 875. However, the net income would get reduced to the extent of interest after tax. Fortunately, the after tax cost of borrowing is given. If it wasn't, we would have had to multiply this with 1 minus the tax rate. So because the after tax is given, then $10,000 is what we've borrowed, multiplied by 12%, that is additional $1,200 would be eaten away in interest cost, giving us a revised earnings per share of 48,800 divided by 875, that is $55.7. So we see that the earnings per share has gone up from $50 earlier to $55.7, which is expected because we are borrowing at 12% and investing in a company that is earning 63%. UC Corp is a US based company. Selected financial data for the years ending December 31, 2012 and 13 is provided below. Use the same to calculate the dividend payout ratio, dividend coverage ratio and FCFE coverage ratio for the 2 years. So let's do it for 2013 first, and similarly we can do it for 2012. The dividend payout ratio is defined as the dividend per share upon the earnings per share, or the total dividend divided by the total net income. Both will give us the same answer. So the total dividend amount is given to be $6 billion or $6,000 million. So this will come out to be 6,000 divided by the net income is given to be $15,000. So it will be 6,000 upon 15,000. Similarly for 2012, it will be 5,500 divided by 28,000. The dividend coverage ratio is nothing but the inverse of the dividend payout ratio. So it will be 15 by 6 for 2013 and 280 by 55 for 2012. The free cash flow to equity coverage ratio is defined as the free cash flow to equity divided by the total amount spent on dividends and share repurchases. So let's first calculate the free cash flow to equity for 2013. So we'll start with the cash flow from operations, that is 20,000. Subtract the capital expenditures, add the net borrowings, and this calculation will give us the free cash flow to equity. So the cash generated from operations, we would have already deducted the interest expense. The money that we spent on capital expenditures and the money that we got from debt can also be used by equity. So this will give us the free cash flow to equity for 2013 and likewise for 2012. For 2013 this comes out to be $1,000 and for 2012 this sums up to be $9,100. The total dividends plus stock repurchases that the company has done is $6,500 in 2013 and $12,500 in 2012. So the FCFE coverage ratio will be calculated as 1000 upon 6,500 for 2013 and 9,100 upon 12,500 for 2012. So we can see that clearly this dividend payout and share repurchase seems unsustainable as the ratio has been consistently less than 1 for both 2012 as well as 2013. So the company is paying out a lot more than it is earning as free cash flow to equity. So that was about the review on dividends and share repurchases. A relatively easier reading, but there are some new theories that have been introduced. So make sure you remember them and you make sure you know how to apply them. So use your question banks, practice a lot of questions, and make sure that you cannot get a question wrong from any of these topics. Thanks a lot and see you next time.